Earlier this week, I discussed how making money in the markets is all about what you find at the margin. So when you find a perceived mispricing in the market, it's really one of those situations where you have to go in and look deeper. And a lot of times, if it's valid, you'll end up actually getting a payoff rather quickly in those kind of mispricings. Now, what is a mispricing in the market? Well, I'm going to give you an example right now of a trade that we did around the initial Brexit vote. So this is a great example of what I mean by when I see a mispricing. And so you can see how these things actually happen quite often. It's not just an anomaly. I mean, you can find mispricing in the market really every single day. It's just the question is how frequently is your trading interval. So if you are a day trader, of course, you're going to have to do them more often. Whereas if you're more of a near to intermediate type of position trader or portfolio manager like myself, then you're going to find these opportunities maybe once a month or something like that. It kind of depends. So the interesting thing as we walk over to the screen here is that when the Brexit vote, the initial Brexit vote, I believe was June 23rd, 2016. The crazy thing, and you'll see it in the chart in just a second, is that within, I want to say, a week and a half or maybe 2 weeks before the vote, which was well publicized and media, everyone made a big deal about it, and it was a big deal, the implied volatility on the S&P 500 was trading as if there was no event at all coming. And so when we looked at that, we said, you know what, this doesn't make any sense. This Brexit vote is just around the corner, 2.5 or 2 weeks away or something like that. We think there's an opportunity to buy some cheap protection, buy basically cheap puts. And so let me flip the camera so you can see what this looked like. So this here is the S&P 500, the price chart on top. It's the actual SPX itself. And at the bottom, what you can see here is what we call the implied volatility, or the perceived risk in that the options market is pricing into the market. And you can see here, so the initial vote was June 23rd, and then the market, this is US markets, of course, ended up reacting badly for 2 days and then rebounded. But what I want you to pay attention to is this area down here, and I'm going to see if I can annotate this a little bit so you can see it better. But the crazy thing was this period leading up to the Brexit vote, which is, again, it's around here. So I believe it was around June 6th or June 7th where I finally said, you know what, this makes absolutely no sense, that the implied volatility, so people were just basically completely complacent to this massive Brexit vote. And so we had an opportunity to buy very, very cheap put options, basically. One could have done many different things, but the point is that the options were very cheap. And you can see as the closer we got to the date, the more expensive these options got. So by having bought them very cheap, so we had a bit of an initial spike on June 10th, 11th, or 12th, something like that, and then a last minute spike into the vote. And then very, very quickly after that, there was an opportunity to basically sell these options, and then implied volatility came down. So it's just incredible to me that you have such a big event, and the options market literally 2 weeks out, a little bit less than 2 weeks actually, just didn't seem to care at all. So this is the kind of opportunity that I like to look at the market. And again, like I said earlier, when I see this kind of stuff, I set up and take notice. And it's the kind of opportunity that really can allow you to kind of push your portfolio into above average type of return generating machine, right? So if you're just let's say benchmarking an index, maybe it's the S&P or something else. Let's assume if you're an indexer, let's say like your mutual fund, but you find these kinds of opportunities where there's mispricing. You didn't have to bet very big, but these are like super, super high probability opportunities. And they're not always, in the options market. They're a lot of times they're just in the stock market or other asset classes, but they become very, very apparent. The question, of course, is how do you find those? Well, that's a matter of having a repeatable process that finds you these things. So if you have a process that we teach our clients every single day of looking at the market from a top-down perspective, looking at different asset classes, and more importantly within the stock market, or additionally looking at different groups and sectors. Again, that's why you have the market rover. By the way, if you're interested in the market rover, please leave us a comment down below or send us an email support@thesteadytrader.com to find out more about that. So I hope this is helpful, folks. Have a great day. I'll talk to you soon.